What's up, traders? Anthony Crudele here, and welcome to the Futures Radio Show podcast. In today's episode, I'm joined by Jeff, also known as 2-Year Flipper. Jeff was one of the first traders in the 30-year pit with a handheld and eventually transitioned to electronic trading for one of the biggest bond traders in the world. Join us as we delve into Jeff's impressive journey as a seasoned bond trader, learn the strategies and evolution of his scalping techniques, and discover why his expectation is to scratch every trade. Let's get started. Today's podcast is sponsored by TradeStation. As a futures trader, you can leverage your portfolio even more thanks to TradeStation's reduced margin rates across popular futures products. Enjoy intraday rates as low as 10% on select U.S. index futures. TradeStation is also cutting margin rates in half for popular energy markets, crude oil, heating oil, gasoline, and their associated minis. Open an account and access over 600 CME Group futures products and customize your trading strategies on a sophisticated platform built for advanced traders. Go to tradestation.com/Anthony to learn more. Jeff, or should I say 2-Year Flipper, welcome to the show, man. Great to have you here, my brother.
All right, 3 years later, and we finally made it happen.
Yes, we did. And of course, today we're going to be focused on scalping. And I think, Jeff, we start off with just what is the definition of scalping? You know, I mean, so much has changed since you and I started. We have a very similar timeline in our background. We were in the pits. We learned how to scalp from pit traders. And when we first learned how to scalp, it was all about second trade first, try to scratch the trade. That was make a couple of ticks or a tick even. And that's how we looked at scalping. And things have changed a little bit. Well, give us your definition of what a scalp is, maybe what it was and what it is to you today.
You know, my definition of a scalp really has never changed. You know, from the time I started as an arb clerk in the corn pit, to the bond pit, to now, I was always taught a scalp is, you have three outcomes. You have, the majority of your trade should be a scratch. And then you have a winner and a loser. It's kind of like baseball, when you're a three outcome player, it's like it's a walk, a strikeout, or a home run. That's kind of how I view scalping. It's a win, it's a loss, or it's a scratch. I mean, those are the only three outcomes a scalper should have.
And when you look at scalping, because we talked about how really the way that I came up in the industry with scalping was we had a lean, and then ultimately we tried to scratch the trade. The goal was to scratch the trade. If you could scratch the trade, it was a great trade, right? I mean, obviously, if the market went your way, you're getting out. And if it went against you, you're immediately getting out. Because I come from the S&P, so for us, ticks were really not as easy to be perfect. A lot of times it was even 50 cents wide, even versus just one tick wide. So we were always within maybe handles. And obviously, as markets have moved now, I mean, when I first started, S&P was around 600 versus it's at 5,000 now. So it's a lot different to try and make 50 cents or a quarter tick on a scalp. For you, is it always just one tick back then and now today when you're looking at trading bonds or treasuries?
It is, because, bonds really haven't changed like the SPOOs have. I mean, bonds are, a point is 32 ticks. It's always 32 ticks. And, for the most part, excluding, economic events, which I try to not scalp, because that's just not my forte, the faster the market, it's always been the same. It's like there's 32 ticks in a point. And typically the bonds, they really don't have more than a point range on a day. Yeah, I know, you go over history. Well, what about unemployment, CPI? Well, of course. But on a daily basis, when I'm scalping now, and especially back, in the early 2000s when the bonds only had a 28 tick range, that's what you wanted. You didn't want a ton of movement like that. You didn't want it to move like a move like in the SPOOs or the NASDAQ today. You get on the wrong side of a NASDAQ trade today, and good Lord, I don't know how fast that thing's going to move, but I can tell you it's not going to be anywhere on your screen. The bonds don't move like that. They're way more controlled than that.
Yeah, I think that is really the major difference. I think that when we listen to people talk about scalping, my perception is obviously from a time where volatility was really low in the indexes. And as time has gone by, the modern day scalper in the indexes is really looking for points now. And they're not necessarily even looking to scratch trades. I think that the same way that I was and that you are. But when you look at the treasury markets, the bond markets, those markets, it's hard to imagine really that this is the case, Jeff. But when you really go back 20 plus years, they don't really move much different. So you're able to have that level of consistency that I don't really know you can have in almost really any other asset class out there.
I agree with that. I think that's how the bonds are. They've always been that way. And, I mean, the SPOOs obviously are a much faster trade than when you started in the pit. I mean, you said 600. I mean, they're at 5,000 now. The amount of movement a SPOO has on an average day, the 1% move is significantly different than a 1% move on when they were a 600 handle.
Yeah.
And, the bonds really don't do that. The bonds are what they are. They're the most consistent. And I think you and I also come from a time frame or a time and a place that memberships matter to us. I think a lot of people can't afford to scratch trades in today's environment if you don't own a membership.
Oh, that's a great point. I mean, really, for my career, I owned my seat for 23 years. I didn't own it that entire time. I leased it for
Well, sure.
But if I didn't have a seat, there was no way I was going to be able to be profitable just because of the mere cost of trading the index.
Yeah, you would go broke. I mean, I look at it now. People will ask me, and I always say, bang for your buck. A tick in the bonds is $31.25. Even as a non-member, I'm going to say a non-member rate's probably $2.50 a round turn. Give or take. So, you're looking at like 33.75 on a losing trade, 29. Whatever, 29.25 or 28.75 on a winning trade. You got a $5 spread. That's actually manageable. That's a good bang for your buck. I'm not positive what it is on the SPOOs, but is it $2.50 a round turn in the SPOOs as a non-member?
Yeah, really, it just depends on who your broker is, but 232 is just the base cost of it, and then you got, a few other fees that are slapped in there, but I think that's why I think when you look at the modern day scalper versus what we are, why not only do you not need a seat in order to do it in the S&P or the NASDAQ, because of the frequency, there's no way you're going to be trying to scalp for ticks and have a really high success rate in the S&P or NASDAQ because no human being can click that fast. It's just not even possible. And the difference is now they've just spread it out and for points. But I think that what I want to do today is just really talk about how even though it's been modified in the index game and it stayed very consistent in the bond and treasury markets, there is still a mindset when it comes to scalping that I think I really want to dig deep in with you. And I want to actually kind of go back to the beginning with you. You've had a really impressive career in bonds. You started in a place that no one will ever be able to start in again. That's the one thing when you look at yours and my career and several others out there, they're never going to be able to go back to the place where we started. And we came from a place where we're able to see things, from a different perspective. You worked as a clerk for one of the biggest bond traders ever. Let's start there. Share some insights about your journey, how it got started, and how it led for you to become a very effective and efficient scalper in the bond market.
Sure. I mean, and this is one of the things that I don't think you can replicate nowadays. Being able to come up in the pit, and traders, for the most part through my career, traders have been very generous, giving you tips, from the pit, all the way. So I was fortunate enough to start working for Chip. Well, at that time, he was probably the biggest bond trader in the world. The years I worked for him, he grabbed me out of the pit as I started trading in the pit as a scalper with a handheld. But like I said, I didn't find much success doing that. I happened to, luck into the position with Chip, and I was fortunate to learn from, you know, who I still think is one of the best traders I've ever met in my life. And I learned a lot of things from him. One of the first things I learned was, you know, manage the trade, not the money. Keep your emotions in check. One of the most impressive things I've ever said about Chip is you could never tell just looking at him, forget his P&L on the day. You wouldn't even know what his position was on the day. Like nobody would know, is he long 2000 or is he short 1800? What is he? You could never gather, like he was stone faced. And that was one of the most impressive things I've ever witnessed in my life.
I would say that every big trader that I ever met in the S&P pit had that very similar way about them. It was never about the size. And I think that the one thing that when I look at all of them, and it sounds very familiar to you with Chip, is that because they focused on managing the trade, they knew where they were getting out. So I think in some ways, do you think it was just because they knew that where they were getting out, or they knew that it didn't matter how big their position was, they felt that they were positioned right enough to where even if they were wrong, they're just blown out of this thing? Or why do you think that they were able to maintain that composure?
Well, you know what, actually, I think the one thing I think they had an advantage of then when we started in the pit, we had that same advantage that we don't have right now is kind of that right of first refusal. You know where the paper is, you know, if the big broker, you know, a broker might be showing a 28 bid for 2000 in the bonds. And you'd be like, hey, I'm 29 bid for 500. I want them. Knowing you can lean on that 28 bid that broker has. And when you're a big local, you're afforded that benefit that, hey, if you say sold to that guy, they're going to give them to you.
Exactly.
And that's such a huge advantage. It does not take away any of their skill. I mean, their skill is still the same. They were still phenomenal traders. It just that was a huge advantage. Like they don't ask me on the screen. I mean, it's not so much in the bonds now when we can get into this later in the 2-year. But if I were trading size in the 2-year, they didn't really say, hey, Jeff, do you really want that 3,000? No, they're not going to ask me that. They're going to hit me. And then I'm going to have to figure out how to manage it. Where can I go to get out of it? I didn't have that right of first refusal. If I put it out there, I could get hit on it.
And that is a really big difference. And I think that, you know, it's funny, and you're 100% right to say that even though they had that edge, which was the pit trader's edge, as far as I'm concerned, was always knowing, you know, if the paper's bid or offered, you could lean on it. It didn't take away from their skill set. And I want to talk about the transition of taking that same mindset from guys like Chip did and other bond traders that you were watching and take it to the screen. Because to me, you have found a way to have the discipline and an edge, even though you didn't have that edge that we discussed in the pit. What would you say your edge is on the screen?
You know, my edge on the screen really was working for Chip, being able to place as many contracts as I placed orders for him. Like I had a job for Chip. I had to be aware of what his position was at all times. I had to know what the brokers were doing. Are brokers coming in selling, you know, 1,000 lots right now that I know I have to race on the screen to help Chip out? Those were things I had to understand while I worked for Chip. You had to be very aware of that. And I learned that screen inside and out by placing all those orders in. This isn't to sound conceited or cocky or anything. It's just I can just see things on the screen that other people can't see based on the volume of orders I placed in my life. And that's a huge advantage for me. And a lot of it was when my money wasn't at risk.
So feel where flow is coming in without looking at a chart,
feel.
without looking at order flow tools, just the feel of the tape.
Right. I mean, I think I'm kind of a unicorn in the sense that I do use one chart now, but I did the majority of my trading my whole life just looking at the DOM and the time and sales. That's all I look at. I don't look at anything else, because charts have never really spoken to me. Numbers speak to me. I want to know, like, I have phenomenal memory, and I could look at numbers and I can recall how the price action was on that number, even if we weren't there it might have happened 2 weeks ago, but I can remember that, hey, wait, the last time we were here, this and this transpired. There was somebody laying in the weeds on this bid. I remember this guy, and remembering that, going, wait a second. I know he doesn't need to buy 500. He needs to buy 4,000. I'm going to lean on that guy now because I know how many he needs to buy. And I'm going to take full advantage of that.
I think that by you doing this in the bond and treasury market, and I see a few others out there that I follow that trade these markets on a regular basis, because I do trade them myself sometimes as well. There is a level of consistency in watching that tape, I think, compared to any other tape out there that really doesn't exist. I think you get an education on a day in, day out basis because the consistency of ranges and the consistency of order flow that's probably coming in and out of there that I think is really unique. And I'm curious, because you've watched it for so long, how much do you think has changed from the time when you started in the late 90s, early 2000s to now?
I think in the beginning, I didn't really have a great understanding when I was working for Chip, understanding those type of orders. But over time, when I went to work for myself, what I really started to pick up on, and I talk about this a lot, are timers. I guess what people officially call them is time-weighted average price orders. And I just have a very good understanding. When I see these orders, I know exactly how long they're going to go for, how many contracts they're going to execute, the exact second these orders are going to be executed. And that's such a huge advantage to me, being able to pick up those things, which is why I don't think I could ever make it in the spoos, because the spoos are, the tape just moves so fast. I can't process the information that quickly. But in the bonds, or in the 2 years, or the 5s, or the 10s, I can very much pick up every one of those orders.
And you're looking at it from a pattern different than a chart, in a way of, like you said, it's a number pattern.
It's a number pattern. For instance, we can kind of delve into the 2-year. If you want to bring up what happened over the weekend, I've gone on some insane streaks in my life trading. Don't have many losing days. When I have them, hey, I'll get hit. I'm a big boy, and ego comes into play, because you need to take a loss every once in a while, because you have to keep your ego in check as a trader. Because the bigger the ego you have, the harder that fall is going to be.
So let me take everybody through kind of what Jeff is talking about here. He's talking about a time in his career where he had an 18-month win streak without a loser. And even, myself, Chip, look at that. I've done pretty good, man. I've had some really unbelievable months and quarters in my career. It's hard for me to remember even months where I didn't have losers. And this is 25 plus years in. So even when I first saw that, I was like, wow. I mean, you're thinking to yourself, that's really hard to even imagine, hard to believe, right? But the way that you approach this and the way that you go about it is different than myself, and I think many others. And I think that, let's lay the groundwork as to how something like that, even can happen, and then take us through just what that time was like, and what you even consider a winning day versus a losing day. And I know that maybe some of those days were just scratches. Maybe you were just scratching a lot of trades, and maybe you looked at that as a win. So let's take us through that whole thing.
So, okay, a winning day for me is any day my account goes up. So I had the streak. Every day it went up. Hey, there were some days it might have only gone up $100, but a win's a win. I had those days. As far as how I look at it, people attack me on it because they're like, "Oh, you're just doing this for clout. You're doing this." I didn't do anything for clout. I don't. That's irrelevant to me. People could have asked the question, was like, well, how is that possible? Well, one, it was a different environment. It was during ZERP. So now you have to go to the 2-year. and the 2-year during ZERP, it's not like the 2-year had these massive ranges. The 2 years traded 8 to 10 ticks in a day, quarter ticks. It's not like they have this gigantic range. But what if I tell you, like, the 2 years run by the K algo? And I don't think a lot of people understand the K algo. I understand it quite well. I don't think I could write the algo, whatever language it's written in. But if you put me in the room with the person who wrote it and say, hey, you both have to trade it, I beat them because I understand how to trade the K algo. I understand every nuance with the K algo, every layering issue with the K algo. I knew it inside and out. And now you throw in the fact that I understand timers. So what if I told you during the 2-year, if at 725 even, I watched somebody sell 100 lot? What if I could tell you that guy's going to execute 49 more times today, and I can tell you the exact millisecond that order is going to go through? Is that an advantage for me?
Of course, 100%.
I knew exactly the second orders were going through. So now you couple the 2-year algo in there. So now the 2-year, so the K algo. So now the 2-year, let's say it's 15,000 up. Let's call it 15,000 by 10,000. And I know, hey, at 7:28 and 30 seconds, somebody's going to sell 100 lot. Okay, that's great. I'm going to quote the market at 7:28 and 29 seconds, and I'm going to flash my orders in. And I'm going to pick up a piece on each one of them. So if he sells 100 lot, now 40 of it goes to the FIFO component of the order, and 60 of them go to people who are quoting, the big players. Okay, so now out of that 60, I just grabbed 30 contracts. So now I'm long 30. There's 15,000 on the bid. Let's just say there's 5,000 on the offer. Well, now I have an edge. I've got a 30 lot. Well, now I know this guy's going to go 15 more times in the next 2 minutes. I'm going to end up having 200-300 contracts on. And believe me, I'm going to work out of them because I've got the edge. It's, I'm not quoting it because I think the market's going down. I'm quoting it because I know it's going up. And they were just timers all day. And I understood when they were coming in, and I knew how to get every piece of every one of them.
So let's dissect this a little bit. First off, I'm going to ask you a few quick questions about this because I think it's important. Number one, you said it was during ZERP, just so everybody understands that zero interest rate policy, in case anyone was wondering what ZERP was. What year was this where you had this 18-month win streak?
During the beginning of the Trump years, 20. Probably the election, 2016 to sometime 2018. That was the time frame.
Talk about the K algo, because I don't think that everyone understands it. Honestly, I don't. It's not something I have any idea of what it is.
So the K algo is what controls the 2-year futures. It's what controls the agriculture futures, the agriculture spreads, and the fixed income spreads.
Well, why is it called the K algo? And like, what is it? Where did this come from?
So the algo it's trying to make it fair to everyone. I'm guessing that's why it was created. So basically what the K algo is in a nutshell, and I'm going to give you the definition in the 2-year. There's different percentages in every market, spreads versus ag spreads versus everything. But in the 2-year, it's basically this. It's 40% FIFO. So that means if somebody sells 100 lot into the bid, and let's assume for right now, it's not somebody's market. It's just open competition. The first 40 contracts that trade go to the first 40 people in line. So in that prior example, when there was 15,000 there, let's say you have a 20 lot in your first, and the trader behind you has a 20 lot, and he's the next guy. You're going to get 20. That guy's going to get the next 20. Now there's 60 contracts left. We'll do the math properly, and we'll say there's 14,960 contracts there. The next 60 contracts gets divided amongst the biggest orders. So if I have 1,000 lot there and I'm the next biggest order, well, they're going to say, okay, there's 60 contracts. He has 1,000 out of 15,000. So now he's 7.5%. I'm going to get about 7.5 contracts. Well, actually a little less than that, but give or take, that's what it is. Now, that same order is going to go through, and I know based on how many orders are in the book, I can look at the book and I can say, well, if there's 15,000 there, and I know 100 lots going to go through, and I can't get 40 of them, I can only get 60 of them. The float's 60. All right, I need to quote 1,005 lots. And if I quote a 1,005 lot, I mean, every times I quote it, I'm going to get 1 to 2 contracts on that. So the second before the order comes in, I click and I get a piece. And I'm going to get a piece on all of them because I know the rule. And the second that order is done clicking, I'm canceling because I don't want the order anymore. And that's, people are going to ask, is that spoofing? That's absolutely not spoofing. Spoofing is putting an order in, taking zero intention of taking a fill on it. I don't do that. I put orders in to get fills. Every order I put in has an agenda. I want to get a piece of it. I play with it. I've always played within the rules of the CME.
Oh, so now I understand what you're saying. I thought when you were saying the K algorithm, you were talking about that was what was leading you to understand the time of the orders coming in. The algorithm that you're talking about is the percentage-based allocation.
Yes.
Got it. I didn't know that was called the K algorithm.
I'm sorry. So the time component that's what people just don't understand. Like I've been looking at the TT screen since 1998. I don't know how many hours I've been in front of the TT screen, 50,000 plus, probably more. I don't know. I learned when orders come in. Like I'll say it sometimes in the bonds. You'll hear me even nowadays go, hey, this guy's going to stop at 2:00. He's going to stop at 2:00. I know he's going to stop at 2:00. This 20 lots going every 15 seconds, but he's going to stop at 2:00. And there are other times I'm going, hey, if this guy goes past 2:15, he's going to go to 3:00. So I know every 15, 20 seconds, he's going to do a 20 lot every 15, 20 seconds. Well, that's a huge advantage to me, knowing that he's going to go to 3:00 because I know he's going to execute 3,000 contracts or 4,000 contracts. So that's 4,000 buys coming into the market.
I see. So what you're doing is you're putting your orders in. So it goes back to this as we dissect this. The consistency that you're finding was through the timed orders, and you notice that as if it was a pattern, as if somebody would say, hey, look, every day what's happening is, let's say, an upside down head and shoulders or something easy for someone to understand, or a 38 fib. It's a repeatable pattern that you're seeing day in, day out, but you're seeing it in a time basis. And then what you're going to do is, because the book's so big when you're trading in the treasuries, because most people that are trading equities would never even understand this. I know that these algorithms are in place. I believe they are for really ags. And I think that, and for, I remember for Euro dollars and stuff like that, I think most people that are not trading these products would never even look at this, because if you're putting an order in the NASDAQ, you're getting hit. I don't really even care where you're putting it in. You're getting hit.
Exactly.
So this is a very different thing. And I actually don't know the ins and outs of how all of that works, but what you're doing is now you're putting in that amount in order to build your position. Now, mind you, at any given time, and I think this is important to point out, that algorithm that you're talking about is only in place as if somebody were to buy 100 or sell 100, like you're saying, and it would equally get distributed across such a huge bid and offer in a market that doesn't have a ton of volatility. So therefore, everyone's participating, and someone just can't put in one huge, large order and absorb both sides, and no one else gets a trade.
Right. That's what it's preventing. The old that used to be a euro dollar trade,
Yeah.
And I think that's why they kind of altered that algo, that it used to be an allocation algo. So then you would get like a big group like Transmarket, who had a ton of capital behind them. Like, hey, put 100,000 on each side. Nobody's hitting us. It's like
no one's going to hit that.
Right. And it's just like ding, 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 plus 30, plus 30, plus 30. Well, yeah. I think they wanted to change that. So they came up with different rules with the algorithms on percentages. And that's how we got the K algo.
and just also people understand that at any point in time, especially when you're getting into 2-year, fives, tens, as big as those books are, there could be anything can happen to where somebody actually does wipe out that bidder offer, and all of a sudden you're hit on the load and the thing flips. So
Oh,
it's not like as
absolutely.
easy as you just leaning on the bidder or the offer in these moments, because the risk is still there.
Right. And I believe that's one of the reasons they changed the 2-year from a quarter tick to an eighth of a tick, is the book was getting so thick. But I mean, I can tell you stories when treasury rolls were like that. And I had never really gotten hit on anything in my life. I'd take 1,000, 2,000, whatever. I remember the first time I took a loss was in the 5-year on the treasury roll. I think I was short like 3,000 or 4,000 contracts. I'm like, oh my God, this is a layup for me. And then all of a sudden I'm watching somebody put like this timer and like selling timers, like selling 100 lots or 200 lots. I'm like, oh shit, I got to buy 4,000 contracts. I got to quote this. And I remember, it's not like I was the only trader who did this. We all quoted it. And then it was PIMCO. PIMCO goes, hey, you guys really want them? There's 250,000 of them. Enjoy them.
And they stuffed you.
And yeah, I mean, that was the quickest 50 grand. I think I lost 55 grand in about 6 seconds, maybe less than that.
So now I understand more of what you're saying. So basically it was a unique time period. You were, obviously, at one of the heights of your game and understanding you what was going on with zero interest rate policy. And you caught onto a timer that was happening on a consistent basis, which is, what's so funny is that people don't even understand this, Jeff, but even back in the pits, so many of the orders were timed orders. And I learned this lesson the hard way too, where you come in and you see Goldman be like, even on 50, you're like, oh, they're only bidding on 50. Right. Mm-hmm. And all of a sudden, somebody be like sold, then they'd be like, even on 50. And then somebody be like, okay, 50 and a half. Oh, buy them. Even on 50, you're like, oh, maybe they only, maybe they're not only just buying 50, they're going to buy 500, they're going to buy 5,000.
Exactly. And they're hiding the orders that people just don't understand.
Well, look at what happened the other day. I was actually watching something on Twitter when there was Simmons, who was really, because he passed away the other day.
Yes.
And he was talking about how he could never get too big. And because there's only so big that they can get before they just start moving the market in too many different directions, right? And people have to understand and think about this. This is why there is a flow to every single day that I think most people don't think about. And I'm glad that we're talking about this because it's very interesting, because this even spills over into equities. If you have to buy or sell a lot at any given time, you never buy or sell a lot all at one time. You do it over time. And a lot of times, in my experience, and this goes back to when we were in the pit and we were able to see this live, they would do them right on the end of the bracket, or they would do it right at a specific time. And people did not realize that. That's why, like, even, opening range matters a lot of times, right? When people look at a 30-second opening range, you go, why would that matter? Well, because if the orders came in right at that time and they continue to come in that direction, they might continue for a period of time. That's why end of the months matter, because all those orders are coming in at a specific time. It's interesting, Jeff, because you're not a chart focused person, that you look at what's happening within the book, that time is actually, and I think we spent a little bit of time on this. That is probably one of your biggest edges, is understanding those timer orders. Is that something you see on a regular basis?
Yeah, that's my biggest edge in the market. That's just by far my biggest edge in the market, are understanding timers, when they go off, how quick one's going to be done, or how long one's going to be done. Because it's like you said, when people need to move contracts, they don't want to move them in one shot. They want to take their time and work into them, because what the ultimate objective on those moves is you want to get more people caught. If you have a bias right now that you want to sell, you're like, hey, below the opening range, whatever it may be, like, hey, I really like selling this. And somebody has to buy 20,000 contracts. Well, if they buy them in one shot, you're going to know, okay, I'm wrong and I'm out.
Yep.
But you get a lot of traders who are like, well, yeah, this guy's slowly grinding it up right now, but he's wrong. I believe in this trade. And then you get other traders doing the same thing. And then all of a sudden you get enough people caught short. Now they're in trouble because now it's going to start to run. And now you get a little panic. And that guy who's been buying, I mean, typically the people who are moving that kind of size aren't in it like you and I for scalping, but they most definitely want to see it. Hey, plus 10 handles in the spoos at the end of the day, plus 25 handles. Like we got an edge on, 5,000 contracts or 25 handles to the good. That's what they want to see.
Yeah, exactly. Let's walk through a typical trading day for you from the moment you start analyzing the markets to the moment you start executing your trades. What does that look like?
My priorities have changed in life. I have a big family. I like spending time with the kids in the morning. So I do not sit down at my desk in the bonds until 8:30 to 9. I'm never in front of the screen for 7:30 economic numbers anymore. I really want the range established on the day. When I come into the bonds, when I start scalping, let's say I'll probably start scalping the bonds 9:45 to 10 a.m. I'm going to start scalping the bonds and I'm going to go to 3 p.m. I'm working 5 hours. That's it. I'm scalping bonds. I want that range established and I want as much info out there as possible. I'm fairly open if people ever want to DM me and ask me questions. I mean, I look at a footprint chart and change in delta. That's it. Now, I've picked up other tricks in the bonds, like things I don't share. Like I could tell you like 3 numbers control every bond handle, 3 ticks, just 3 ticks control every bond handle. There's an algorithm that runs. If you learn it, you can make a lot of money if you understand how it works. I've worked my career to figure it out. And those are the things I look for. I wait for us to get towards those levels. If I see it going, I'm going to go with them and I'm going to join them. And I guess the best way to describe me would be if we're going to go even to 10, let's say that's a move and say, well, hey, Jeff, you bought a 20 lot at even and you're going to sell 20 at 10. You made 200 ticks on 20 by 20. Yeah, I would love to be able to do that. I can't. Now I might do that. I might finish 200 ticks, but I probably did it on like 600 round turns going even to 10 because I'll change my mind multiple times in between.
So let me ask you this. How much of your trading is taking place in the middle of the range, the edges of the ranges? Do you find any edge in any particular part of the trading range after you watch it be established?
I find my edges come from the change in delta is where I get my biggest edge from.
Talk about that. My next question was going to be why. So you're looking at delta, why, and how is that important to you?
So there's nothing special I look at in the bonds. It's just 15 minutes only because, 1 minute chart's just not big enough. It's not a big enough sample size for me in the bonds. I want to look at 15 minutes and I want to see what the change of the delta is on that current day. And as I said, I have a phenomenal memory and I'll remember the past couple days. So I keep that in mind too. And I look for big change in deltas. Like, hey, like the other day, somebody was short the net change or somebody was short 5,000 bonds, kind of towards the low of the day. And my thinking was, I'm like, look, hey, we're not going to move back down there. That guy needs to buy those things. I'm going to fade that. Like as we were getting down there, I'm looking to buy off that range because I know that guy needs to buy. So I'll take advantage. I'm like, if the guy was short, say at 02, the net change, there was somebody, the net delta was minus 5,000 at 02. As we go down there, I'm like, all right, what am I buying here? Am I buying 3s? Am I buying 4s? I'm looking at the 10-year ultra and I'm looking at time and sales, looking for a little edge that says, wait, now's the time to buy. And I'm going to jump and buy those 3s because I'm banking that guy's there. He needs to buy them.
Yeah, I love that squeeze trade. I think anybody who follows any order flow tools understands that. And basically, if you didn't understand that, it's just what Jeff's looking for is that anytime a market gets towards the close, which is why I love the end of the month so much. I've talked about this so many times on this show and on Twitter X, is that anytime that the market is going in one direction and the delta gets really, really juicy and all of a sudden it gets towards the close, I mean, there could be, if you find any reason for that trade to unwind a little bit, that's probably just about the best information you're ever going to get because that order or those orders could come in hot and heavy, right, Jeff?
Exactly. I mean, it's all about finding edges that work for you, and which is why I'll never say anything like people find edges in charts. Just because I don't find an edge in it doesn't mean they don't work.
Exactly.
You know what? Every trader, the most important thing any trader has to be able to do is find an edge that works for them.
Yeah. Let's talk about the criteria for evaluating success of their trades. You've mentioned that aiming for a 20% win rate on a daily basis would allow you to achieve a remarkable P&L by the end of the day. I'd like you to elaborate on this more and provide some insight on how you measure the success of your trading, the approach, and the expectation that you have for yourself and your trades.
Sure. So, I mean, I was taught when I was first taught trading, I'm sure you were taught something along the same lines. It's like, hey, if for every 10 trades we execute, we're going to scratch 6 of them. You want to win on 3 of them, lose on 1 of them, you're +2. So forget what your unit size is. That's irrelevant to the conversation. But for bonds, let's just say an average clip size for me in the bonds is a 20 lot. That's kind of my sweet spot. I like trading about 20 lots. So every winning trade $625. So if you look at me and you're like, okay, so Jeff's going to execute 10 trades, let's say for 4 hours straight, I do 10 trades an hour. That's what I do. It's like, okay, every 10 trades. So Jeff did, 40 trades and, he's +2. So he's +8 trades at the end of the things. Well, 8 times 20, that's 160 ticks, which is $5,000. Count commissions in there. Let's just say I paid 50 cents a round turn. And, if I did, what I said, I did 40 trades. So 40 times 20, I did 800 round turns. Let's just call commissions $400. Well, I mean, I just walked away with $4,600. Now, every day isn't like that. Some days have way more opportunities than others. My favorite afternoons to trade right now are unemployment, CPI, and PPI afternoons.
Why?
I love trading those afternoons.
The squeeze trade?
Well, it's not just a squeeze trade. It's just I know it's going to be busier. I want a little volatility, but I want to stay away from the volatility of the number because, as you know, I don't need to explain to you, but numbers are hard to read. I mean,
oh boy, are they?
Yeah, I mean,
especially these days.
I joke about it. Unless you get like an NFP number like completely out of whack, you could give me the NFP number, and I'm be like, hey, dude, we're going down here, and you'll be like, Jeff, I thought you said we were going down. I'm like, well, based on the number, we should have gone down, but we spiked up. Reading the numbers isn't as easy as it used to be.
No. And it's just too fast. I mean, it's just gone. Like the other day, I watched the bond market rally. The whole time I'm waiting to get long. I've been wanting to buy treasuries. I thought they were going to go, up. I thought we were going to see a little bit of a rally. And then, the number comes out and they wipe the whole move up in one bar. And it's like, okay, now what? The rest of the day they chipped them lower and they've kind of chipped lower since. But it's just, but I understand why you like more towards the closes, especially for those markets because of your style, because now the range is in and you do, people don't think about this, Jeff, because people are in such a big hurry to trade and to make money that most people are trying to anticipate the range versus letting a range settle. And once you have more information, make a better trade decision. And I find that very interesting in your approach because you're probably the shortest term trader I know who actually takes the most amount of time to get in the position versus most of these other people are trying to predict the range. If you look at it from that perspective, and they're spending the least amount of time and getting the least amount of information in a day. It's kind of interesting.
Yeah, I agree 100%. I say it all the time. I'm not that smart to know that. Honestly, if I were that smart and I knew what the range was going to be every day, why wouldn't I just put on 100 SPOOs? If you knew what the SPOOs range was going to be every day, just put 100 lot on and be like, hey, buy tick off the low, sell tick off the high. And, you're a billionaire, relatively quickly with that stuff. I'm not that smart. I want as much information out there as possible. The more information I have, the more I can dissect the market and make an educated decision.
A lot to take in for today, Jeff. I want to close out with just some advice. I think that a lot of traders really have the mindset that you have internally. They're trying to do this, what you're doing in equities, and maybe it doesn't work for them. I think one of the most important things that traders need to do is to look beyond just equity markets, because really almost everything is S&P and NASDAQ, obviously, a little bit of Russell, a little bit of Dow, but everybody is so index based. But some people, I think, obviously your skill is refined and you've got a ton of experience. We get that, right? No one's going to come in and be, Jeff tomorrow. But I think there's a lot of aspiring traders out there that are even scared of the bond market and just focus on equities, but they probably have the potential skill set to become a scalper in, bond or treasury markets. What advice would you give to them?
The first thing I would advise anyone is to go in and scratch 50 trades in the SPOOs. That was my goal for the day. When I first worked, somebody was showing me the ropes. Like, hey, you got to try to scratch 50 trades in a day. Now, different time back then when I started the SPOOs, I wouldn't recommend anyone doing that now. But I would recommend anyone who is looking to get into the treasuries and take an hour during the day, try to find an edge in the bonds and scratch 10 one lots. There's nothing special about it. It's putting in the time and effort to understand the market, figure out a correlation that works. Correlations have changed over the years. The Bund used to lead. We used to be inverse the S&P. Now, I don't know what the bonds are to the S&P. They change. But there are times during the day that the SPOOs lead the bonds, and there are other times they're inverse. Your job to do homework to find that time frame that works for you. It's really just taking the time to look at the screen and keep your expectations low at first. If you keep your expectations small and you do the work, adjusting your size really isn't that big of a deal. It really isn't. You're still managing the same trade. The entry is the same entry, whether you're doing a 1 lot or a 10 lot. But the reason you enter has to be the correct reason to enter. You can't enter because, that moved real quick. Well, that's the first time I've ever seen it happen, so let me go on it. No, you have to come up with your game plan of why you're getting into a trade.
I love it. And, Jeff, this has been 3 years in the making. It's great to finally get a chance to speak with you. I'm sure we're going to do this again now somewhere down the road, but after many years of chatting with you on Twitter, it's great to get a chance to know you, get to hear more about your background, your successes. Anything else you want to add to today's conversation? And like I said, it's been really something in the making for years, and just wondering if there's anything else you wanted to discuss today.
You know what? I wish everyone well. I always the only thing I like to do is I actually do like to try to pay it forward to people. If anyone ever wants to reach out and DM me, please, feel free. I'll answer questions. I'll never charge anyone for anything. I'm not going to back anyone, but if somebody's lost and they need an ear to ask questions, reach out. I'm happy to talk to people and just pay it forward because, like I said, you never know what one little piece of advice might change somebody's trading career. And if I can help them, I'd be very happy for them if I could help in any way.
Jeff, it's been a pleasure speaking with you, my friend. Thank you so much for taking the time. Glad we got a chance to finally do this. And I look forward to future conversations with you down the road, man. It's like I said, this was a lot of fun, man. I appreciate it.
Thanks for having me. It was a blast.